this is going to be recorded, so you'll have something to look back on. But I'm delighted to, just be here with you today to introduce our speaker for our first community impact briefing of 2024. And I have Michael Fratantoni, with Chief Economist with the Mortgage Bankers Association, along with myself, Raquel Reddy, the Vice President of Community Development, and my colleague Elizabeth Coates, our Director of the Homeownership Alliance. So thank you for being here. And you're here because you wanted to get some insights, some of the latest and greatest on the economy for 2024. And we have one of the best here to lead us on that and to share a little bit. But before we do, I do want to just share a little bit about Michael's background with you all, and then we will begin. So Michael, hang tight. Michael Fratantoni is the Mortgage Bankers Association's Chief Economist and Senior Vice President of Research and Industry Technology. And in this role, he's responsible for overseeing the MBA's industry surveys and benchmarking studies, including economic and mortgage origination forecasting, industry technology efforts, and policy development research for both single-family and commercial and multifamily markets. Additionally, Michael's a member of the board of directors for MISMO and on the membership committee of MERS. Prior to joining the MBA, Michael worked in risk management and was a senior economist roles at Washington Mutual and Fannie Mae. He received a PhD in economics from Johns Hopkins University and a BA in economics from the College of William and Mary. And has served as an adjunct professor at the University of Washington and Johns Hopkins, George Washington, and Georgetown universities. To say that he is in demand right now is an understatement. So Michael, thank you for joining us today. We will be taking questions for Michael at the end of his presentation, so please use the Q&A and the chat to help us with that. With that, Michael, please feel free to share your presentation and get started for us.
Great. Thank you for having me, Raquel. I appreciate the opportunity and glad to be with everyone today. As Raquel said, my role here today is to talk about our outlook for the year ahead. And as she said, I'm talking to a lot of our members, a lot of other folks about the exact same topic. Very, very common thing to be thinking about in January as we're starting off the new year. So I'm going to start with just sort of big picture where we think the economy is headed, what we're expecting in terms of the path for rates, then delve into a bit more with respect to specifics on housing and mortgage markets. But biggest picture, as you all know, headlines every day really highlighting just the tenuous geopolitical situation we're in, whether you look at the ongoing situation in Ukraine or what's going on in the Middle East. And, it just seems like every day there's a new angle to that. And when you talk about the Middle East, oftentimes concern is, well, are we going to see a repeat of what's happened in the past where geopolitical issues there result in a spike in oil prices, which then tanks the global economy? And, definitely something worth watching. This is an environment, though, where globally growth has slowed quite a bit. And that's true in China, and some new headlines about that today. They're really struggling through a property crisis, which has been building for years. And even despite opening up their economy post-pandemic, just really having trouble getting momentum. Same in Europe. I think, whole of Europe, if you were to characterize with one word, it's stagnant. And so, this chart is showing a couple of things. One, looking at oil prices and some concern there, but you have this tension between what's happening geopolitically versus the global economic weakness. You have on the right that it's not just the US that's struggled with high inflation, it's the rest of the world as well, and central banks uniformly responding to that spike in inflation. And the left just showing that despite the troubles we've had here in the US, at least from a financial market perspective, the strength in the dollar really showing that relative to other countries, we're not doing so bad. So that's sort of the biggest picture. here's just a summary of what we're thinking with respect to the US economy. Um, Lots of conversations lately about whether we'll be able to achieve a soft landing that would be decrease in inflation without a recession. I think it's going to be touch and go this year. We certainly expect the unemployment rate's going to increase from the 3.7% we had in December to about 4.5% by the end of this year, maybe go a little higher next year. So some weakness in the job market, but not too much. But then, as we're showing here, do expect that inflation will come down to the 2% target the Fed's been aiming for. And that, coupled with expectations about where the Fed's headed from here, going to be beneficial for lower 10-year Treasury yields, lower mortgage rates. We do expect that home price growth is going to remain positive, but certainly is going to be slower than what we've experienced the last couple of years. So that's sort of broad brush. Let's dive in a little bit more. Obviously, the pace of inflation really has been driving a lot of particularly monetary policy change and discussion in recent years. And it's really important to just remember that we just lived through an experience that we hadn't seen in 40 years, with headline inflation getting to 9% on a year-over-year basis in early 2022. And you have to go back to the early 80s to see something comparable. The Fed sort of slammed on the brakes with respect to conduct of monetary policy, increasing their Fed funds target very, very sharply. And for better or worse, that medicine has worked, right? So you see the inflation's come down now between 3 and 4%, depending upon which measure you look at. And we fully expect that we'll be back to the Fed's 2% target here relatively soon. And the other side of the coin, though, is the cost of reducing that inflation on the job market. And so what I'm showing here, the dark blue bars are average monthly job growth going back the last 20 years or so. And you see the huge job losses that first year of the pandemic in 2020, the very strong recovery in 21 and 22, fastest job growth we've seen in a really long time. And then the light blue bars are the monthly job growth that we saw in 2023. And for us, as well as most economists out there, the surprise in 2023 was that these job growth numbers stayed stronger and that unemployment rate stayed lower than we would have expected, given, again, the Fed slamming on the brakes in the form of higher interest rates. So, a few qualifications on that. One, you don't have to squint too hard at those light blue bars to see it's trending down. And also, there are some challenges with measurement in a turn of the cycle like we're experiencing right now. So, for example, the December number of 216 came out, but that was coupled with a downward revision in the October and November numbers. And when the November numbers came out, the September and October numbers were revised down. And this is, not unusual. It's what happens when the economy slows. But we expect that, when the final word is written on 23, that job growth will have slowed even more than what we're showing here. And again, our expectation is it's going to slow further going ahead. And, why would I say that? Got a couple of additional data points here. One, something the BLS puts out, something called a diffusion index, which is looking at the percentage of industries that are net hiring versus net laying employees off. And you can see in 2021 and through 2022, almost every industry in the economy was hiring, adding to payrolls as they were trying to recover as the economy was moving out of a pandemic time period. But as we got into 2023, and even at the end of 2022, fewer and fewer industries were hiring. And you hear that in the news around some of the latest job market reports that, outside of government, healthcare, education, some of these sectors that really tend to hire almost regardless of the economic situation. Many other sectors were flat or reducing payroll count. So that's really a prelude to a broader slowdown in the numbers. Even beyond that, though, there's another data set called the Job Opening and Labor Turnover Survey that the BLS puts out. And this one has gotten much more attention over the past couple of years than ever before. Looking at the green line, what that's showing is just the number of job openings in the economy. Early 2022, that hit an all-time high at 12 million. One of the ways to scale that is at that point, there were about 6 million people that were unemployed, actively looking for work. So there were 2 job openings for every person that was looking for work. And, there may be mismatches, but again, a sign that the job market extraordinarily tight. That since has come down. We're down to about 8.5 million in the most recent data point. That 8.8 is a little bit dated. And that really is showing employers, rather than first turning to layoffs, are first closing those vacant open positions. So demand for labor is dropping. So instead of 2 opening positions for every person looking for work, now there's maybe 1.5. And we do expect that's going to further decline as we get through the course of 24 and 25. Beyond the drop in openings, you see the hires rate has dropped. And the other one that's getting more attention, the quits rate has also dropped. Why is that important? Well, you just sort of makes sense. Someone is much more likely to quit a current position if they have another position lined up. In a world where fewer open positions, fewer employers are looking to hire somebody, that current position is looking a little better. And so the quits rate is coming down. So all those indicating a weakening job market. What else do we have that's a potential headwind for this economy? Well, if you remember back to last spring, the news was the sudden failure of a couple of very large banks. So Silicon Valley Bank, Signature Bank, and then later in the spring, First Republic Bank. These were 3 of the 4 largest bank failures in US history. This is coming at a time when the banking system as a whole was already struggling to hold on to deposits. With interest rates having increased as much as they have, savers had the opportunity to move their funds into money market funds and other short-term instruments that paid a whole lot more than bank deposits. And so what the chart on the left was showing is just the level and the year-over-year, in this case, decline in the level of deposits in the banking system. So if you talk to bankers, many of them are feeling quite constrained in terms of their ability to put new loans on the balance sheet. And one way that's reflected is that chart on the right, which is from the Fed Senior Loan Officer Survey, where credit officers are reporting, look, we are tightening credit criteria on just about every line of business. Now, outside of really recessionary periods, we just haven't historically seen credit this tight in the banking system. So couple that with the price of credit, the availability of credit is down. This is going to be a real challenge in 2024 for growth to continue, at least at the same pace that we had in 23. Okay, so I've talked about rates a lot. What actually is the data showing? So let me start at the short end of the curve, the blue line, the Fed funds rate. Remember, during the pandemic, the Fed did everything they could do, brought the short rate down to 0. Beyond that, also dramatically expanded their balance sheet, buying longer-term treasuries and mortgage-backed securities, all in an effort to keep financial markets functioning and to help support the economy through the pandemic. But when inflation started spiking, again, reaching highest levels we've seen in 40 years, they did an about face very, very quickly. So if you look at that blue line, went from a Fed funds rate of 0 to the current level between 5.25 and 5.5. Now, we are once again at a turning point. At the December FOMC meeting and the press conference following, the statement and then Chair Powell's comments were, we think we're at the peak. No promises. If inflation were to go higher again, they might have to raise further. But again, we had Governor Waller just yesterday, again, emphasizing the point that they're at the peak now. And so now it's a question of When are they going to begin to cut rates? And how quickly will they cut rates once they begin to cut? Our forecast, as shown here, is that the first cut will be in May, and they'll do 3 this year, another handful in 25, and a few in 26. We think they'll probably level off somewhere between 2.5% and 3%. That will be a neutral rate, provided we don't have any event which would cause them to go lower or higher than that. So that's the expectation for the short end of the curve, and that 2-year Treasury yield is going to follow Fed funds rate moves really pretty closely. The longer end of the curve, a 10-year Treasury or a 30-year mortgage rate, is really going to move in advance of those moves by the Fed. Really, that's the market's best prediction of where short-term rates are going to be over the next 10 or so year period. So we saw the 10-year yield as high as 5% not too long ago, towards the end of 2023. But once this news came out that the Fed was turning the corner, it quickly dropped to a neighborhood of 4, sometimes below, sometimes above, a little bit above today. And mortgage rates, which had peaked at about 8%, are now at about 6.75%. Showing here our forecast, we think the 10-year Treasury rate will level out somewhere around 3.5%, and the mortgage rate get down to about 6% from the 6.75% where we are today by the end of 2024, and drop below 6%, maybe to 5.5% as we get into 25 and 26. You can see that 5.5% mortgage rate, nowhere near the lows that we had seen in 20 or 21, and actually above where we'd been for much of the last decade, but certainly better than the 8% rates that we just lived through. Okay, so what has all this meant for the mortgage market? Well, each Wednesday morning, 7 a.m., we put out our weekly application survey. You saw the news this week, application volume up just a bit. We always report out what's happening on the refinance side versus the purchase side. Refinance very much driven just by rates. And so we've seen some percentage gains in the level of refi volume the last several weeks as rates have dropped, but the level is still really, really low. We're still about 90% below the pace of refi activity that we saw in 2021. It's all about rates. If you look at the distribution of rates on outstanding loans right now, about 90% of homeowners with a mortgage have a rate below 6%. So 6.75% is providing nothing for them. About 60% have a rate below 4%. So even if my rate forecast is right and we get to 5.5%, they're not going to be interested. So a market that's been very dominated by refinances for years and years, we think refinances are going to play a smaller role. And much of the refinances that get done are going to be cash out refinances where borrowers use accumulated equity for other purposes. Now, not only was the refinance market slow in 23, the purchase market was slow as well. So this is, again, looking at our weekly application survey data. That bottom line is 2023. The gray line is 2022, looking week by week throughout the year. Most weeks we were 20% plus behind the level of activity in 2022. That was beginning to narrow as we got to the end of the year, particularly as rates began to fall. But on the purchase side, it's not just about rates. It's really also largely about availability of properties, and I'll talk more about that in a minute. But first, let me just speak to what we think is really a positive force for housing over the next sort of medium period of time, call it next 6 or 7 years. And it's just looking at the age distribution of the US population. So the chart on the left is just looking by year, just the number of individuals in the US population. And the yellow, that's the millennial cohort, really highlighting the 50 million people in this country that are between 30 and 40. Now that age range is important. That's when household formation tends to be at its highest level. We're now seeing the US generate about 1.5 million households per year. Just by comparison, if you were back in 2010 or really any time in the first part of this millennia, it was closer to 1 million. So just because we have more people at an age where households are formed, we have a higher household formation rate. The other point about that is if you look at the chart on the right, this is the age at which, if people are going to buy a home, this is generally when it happens. So look at that home ownership rate for those under 35 at 38%, jumps to 63% for those 35 to 44. So the millennial cohort got married later, started having kids later, bought cars later, they're going to buy homes later. So we're seeing time at our age at first home ownership, has moved up from the low 30s to the mid 30s, but it's still a time of life when many people are buying homes. So the demand is there, and we think the demand is going to be there for the medium term, sort of 5 or 6 years, at least, given that distribution of the population. The supply is not there. And this is a result of just underbuilding for the last 14 plus years now. So this is data on construction of all types of housing units: single family detached, attached, 2 to 4s, small multifamily, large multifamily, manufactured housing. If you look from 1970 to 2009, we were building 16 to 18 million units per decade. If you look from 2010 to 2019, we built 11 million. So lots of estimates out there about how deep in the hole we are. 3 million, 5 million units underbuilt given the demographic demand and what we can support. And this is all types of housing, rental or for purchase. But we just don't have enough housing units in the country one way or another. 2020 is not getting off to a good start due to the pandemic. Hopefully that will improve in years ahead. Couple that now with having experienced record low mortgage rates during the pandemic, and now a sudden spike up in mortgage rates. With the structural undersupply of housing units, we also have what's called a lock-in effect. So the blue is looking at the number of existing homes that are on the market. Typically, you'd expect 5 or 6 months of supply, which would get us to 2.5 to 3 million homes. Right now, we have about 3.5 months of supply, so just over 1 million homes on the market. You have a lot of homeowners who just are not interested in giving up an extremely low mortgage rate, even if there are opportunities to move. One solution to this lack of supply is for builders to pick up the pace of construction. That's definitely happening. Look at that orange area. That's new home inventory. We have about 7, maybe 8 months of supply, depending upon the month. 400 to 500,000 units. And that's showing up, this combination of a lack of existing inventory and a growing new home inventory. Look at that gray line, which is showing the proportion of homes on the market that are new construction. Typically, we'd expect 5 to 10%. We're above 30% right now. So a very, very unusual mix in the market, leaning much more towards new home construction at a time when many of the potential buyers are much more likely to be first-time buyers, given that the size of that millennial cohort. So we are seeing builders decrease average size of a new home and the price point, maybe building out a little further to try to, again, attract some of these new buyers who are sort of the most likely candidate to purchase one of their homes. We expect that pace of construction is going to continue to increase over the next couple of years. So we're looking for both single family starts and new home sales to increase. New home sales up about 10% in 24 compared to 23 in our forecast. And we do expect that some of this lock-in effect is going to begin to fade. So we're looking for about 5% growth in existing home sales. Now, why would it fade? One, just with rates coming down, it makes it a little bit less painful to give up that really low rate. But probably more importantly is just life. People are getting married and having kids and getting new jobs, other things which cause them to move, even if they're not thrilled about giving up a 3.5% mortgage rate to take on a 6.5% mortgage rate. Sometimes that's just sort of what life requires. But think about this combination, particularly with that demographic slide I showed, of very strong demographically driven housing demand running into a structural undersupply in the market. During the pandemic, couple that with record low mortgage rates, and we saw home price growth reach levels we'd never seen before. And even including the run up to the great financial crisis more than a decade ago. So FHFA home price index showing home price growth near 20% nationally on a year-over-year basis. Now, when mortgage rates spiked, certainly everyone expected that pace of home price growth would slow because you're reducing demand. We were more optimistic than most, but we were not optimistic enough. There were some that were predicting 10, 20% declines in home prices. We didn't think that was ever in the cards. Instead, for full year 23, we think we're going to wind up with a number like 5.5% growth. Over the next couple of years, as more supply comes online, we do expect home price growth in the neighborhood of 3 to 4%. Just by context, that's probably going to be below the rate of wage growth. So affordability, which has been a real challenge through this environment, probably going to get a little bit better. One way we measure that, chart on the left, is looking at the ratio of the median principal and interest payment on a new mortgage to typical weekly earnings. And you can see as that spikes up, that's homeownership becoming less affordable with much higher mortgage rates and home prices still going up. On the right, we can compare that mortgage payment to asking rent. Rents were going up a lot during the pandemic too, and immediately coming out of that, over the past 6-12 months, we're beginning to see some rental declines. So, a couple of different variables here going forward. We expect mortgage rates to come down, home price growth to slow, a little bit weaker job market, so that may slow wage growth too, but we do expect wage growth is going to be above home price growth. But we do expect rents to come down or level out for a bit. So there may be some tilt in that buy versus rent decision towards rent, particularly in some markets that have a lot of multifamily supply showing up. Now, the downside of the very rapid home price growth is for that first-time buyer trying to get in the market. The upside is for the owner that owned their property through this run-up in prices. And we see it in the aggregate data. Look at that blue line. Aggregate home equity near 32 trillion. We've never seen numbers like this before. The orange is looking at to the extent people are using home equity debt to pull out some of that equity, and it's just a drop in the bucket. 491 billion against that 32 trillion. So, pre-great financial crisis, there was a concern about people using their homes like ATMs and pulling that equity out as fast as they were accumulating it. It just isn't happening today. And instead, you have people much more cautious and conservative about using that equity. Now, I do expect that's going to change a bit. I talked about cash out refinancing, and here we're showing data from a home equity lending study that we conduct each year. Why would people pull equity out of their property? Most often, and the most common use is for home renovations or remodeling, a huge expenditure. This is probably the most efficient way of financing that. I do think, though, in the years ahead, that light blue portion, that debt consolidation or restructure, is going to become more important, both for home equity lending and for cash out refinancing. You look at credit card outstanding balances now, north of $1 trillion. Your average auto loan for a new car is $40,000, and they're extending 7 or 8 years now in many cases. Student loan payments have started again. So a lot of stress on consumers, and we're actually seeing delinquency rates on credit card and auto loan balances begin to increase. So I'm not going to be surprised if we do see some cash out refinancing pick up in the course of 2024 and some additional home equity lending. And it can make a lot of sense, right? Just given the very high rates that people have on that credit card debt, which again is extraordinarily high right now. So in thinking from a mortgage industry perspective, do expect that 2024 is going to be a little better than 2023. So this data is showing the number of mortgages originated each year. So 2021, 14 million mortgages that fell by more than 50% in 2022 to less than 7, and then fell to 4.3 million in 2023. And you look across this page, you don't see any number that low. Our estimate is you have to go back to a year like 1997 to see that slow a pace of lending. It's about 1.6 trillion in dollars. We see that increasing in 24 to more than 5 million loans, about 2 trillion in dollars. Growth on the purchase side as we get more existing homes, more new home sales, and home prices going up. And some growth in refi, that red line, again, predominantly cash out refinance, probably some refinance opportunities for those that got that 8% mortgage last year at the peak, and this year might be able to get a 6% loan. We expect, as given that demographic push, that lending volume is going to continue to increase in 25 and 26, but it's going to be dominated by purchase lending, not refinance lending, given our outlook for rates and given the distribution of rates on outstanding loans. So a very, very challenging environment for lenders, depending, again, which data you look at. Industry employment is down 30% plus. A lot of desire to use more technology in lending. And here I'm just sharing a chart from a recent Fannie Mae study, which was really sort of the topic of the year in 2023 was potential implementation of different AI tools. And this is looking at use of those AI tools in mortgage lending for compliance reviews and sort of fraud detection, anomaly detection, et cetera, and sort of down through. You hear more and more about use of various chat bots on lender websites, et cetera. Not decisioning, right? This is not going to be a tool that's going to be immediately used for making a credit decision given the regulatory challenges, but for some of the more onerous tasks, which if you can get a technology tool to do it rather than hiring more people, and then sort of the endless challenge in mortgage lending of hiring up during boom times and laying people off during slow times like 23, more technology, the better in many cases. Last thought, Raquel, and then would love to open it up to questions. Just on the performance side, because the job market has stayed stronger than we thought, and because home prices have stayed in there relatively strong, we're seeing mortgage delinquency rates about as low as they've ever been. And this chart just highlighting that they tend to be very, very highly correlated with the level of the unemployment rate. We do think unemployment is likely to rise in 2024, maybe to 4.5. But again, if this correlation holds, that would mean somewhat higher delinquencies, but really nothing compared to what we've seen in prior cycles. So I knew I ran through quite a bit there in a pretty short period of time, but let me stop and see if there are any questions or comments.
Thanks so much, Michael. Yes, please put any questions or your comments in the Q&A or chat. I have a couple to start us off, and Michael, just a student of economics myself, have a couple questions for you. Kevin Moody, you raised your hand. Let's see if let's see if I can get you on. Hold on, Kevin. Sorry about that. We normally see it in the chat. Okay, Kevin. Go ahead, Kevin. Let's see if we can hear you. Unmute.
Okay, can you hear me now?
Yes,
Yeah.
you sound good. Hi,
Okay.
Kevin.
Happy New Year, and Michael, thank you very much for the presentation. If I can interpret then what you're saying, we should continue and move full steam ahead with purchasing properties, fixing them up, and if we have any new bills to get started. Would that be pretty much a good synopsis and summary of what you said, or did I read you wrong?
You heard me correctly that there is an undersupply of housing in this market, and if you can do your part to help bring some additional units onto the market, that is going to help.
Thank you.
Thanks, Kevin. Well, on to that, just kind of leading back to one of the items that you talked about, which was, of course, mortgage originations, really slowly increasing, of course. But I wanted to know, in terms of the diversity of the home product, are you starting to see an increase in those purchasing, let's not say your single family traditional detached? Are you seeing a diversity in maybe more manufactured housing? I know that's, lender by lender, but any thoughts on that, Michael?
Yeah, so I really emphasize the lack of affordability in today's market and the challenges folks have getting into the market. And so that can show up any number of ways, right? That's buying a townhouse instead of a detached house. It's buying a condo instead of a detached house. It's going to a farther out suburb as opposed to a close-in suburb, maybe because you're only going into the office 2 or 3 days a week, and that can be a sensible choice. And in those outlying suburbs, it can be a whole lot easier and less expensive for builders to put up more units more quickly, right? So I think all that's going to help. Yeah, the manufactured or modular or the various different approaches to bring down housing costs. Again, I think those are going to be most impactful in those areas where you can put up more units more quickly, right? And the land is less expensive. So I think all of those are potential directions we could be going to address the affordability challenges.
Thank you, Michael. Let me just see if there are any questions coming up. Okay, let me ask another one. You sort of touched on this with delinquencies going down, but for those lenders that are still working through loss mitigation strategies, do you find that there is now enough equity, obviously equity in homes, that folks are utilizing that to, get through that process, whether it's modification otherwise, with lenders that are working with them? Are we going to continue to see more of that, or is it at its end now?
Yeah. No, I think that is a very, very good point, that the fact that even borrowers who may be falling behind still have, in some cases, substantial equity in their property. That makes the whole conversation a whole lot easier than it was in 2010 or 2011, right? And opens up more opportunities. But we're just not seeing distressed sales in any significant numbers anywhere, and that also benefits the market, helps to maintain those prices.
Thank you once again, Michael. Just a reminder again, if you have any other questions, please drop it in the Q&A or the chat. I have one more. This is something that we've been hearing more and more about over the last couple of years, and it sort of backs into your question of, again, the equity that folks have in their homes, and the renovation or remodeling, portion or percentage that you showed in
Yeah.
that graph. Of course, you think more will go towards debt consolidation. But for those that are doing sort of the mortgage renovation or remodeling, do you have a sense as to whether or not they're actually adding space, like in an ADU? That's something we've been hearing more and more about, the accessory dwelling unit, whether that's to utilize it to increase wealth by, being able to rent it out, or perhaps having someone move back home and needing more space. Any thoughts on that?
Yeah, unfortunately, in that study I showed, we don't have more detail on that of the types of renovations that are being done. Certainly, I'm hearing a lot about ADUs. And then the other angle we have on that is, the FHA 203K program, which is designed for a homeowner to really finance that renovation. A lot of interest in that product. And I think some of the changes that FHA's made that to really increase the amount of financing a borrower would have to work with is a really, really good move in this environment.
Thanks so much. I know we were, and Elizabeth might have some update on this with some letters we've been writing on behalf of the program there, 203K. Yeah, this has been wonderful, Michael. Of course, I don't know if you have any additional information on sort of the breakdown of home ownership rates amongst Black or Latino households, if that's something you can touch on. If not, maybe we can follow up with you on something like that too.
Yeah, I mean, I think despite these affordability challenges, we're seeing the aggregate home ownership rate sort of hang in there in the sort of mid 65% range. And for the different racial and ethnic groups, they're not moving too much, but I think is good news, right? I think given the level of headwinds we're seeing, I think there was a worry that they would drop. They're not increasing the way you want them to. We still have a lot of concerns about that racial home ownership gap. So not making a lot of progress on it, but it's not getting worse at this point is the way I'd characterize it.
Thank you for the additional feedback on that. This has really been wonderful. I'm just going to check one more time if there are any other questions. I don't see anything in the chat right now. I did want to mention too that Michael, you're going to be providing your presentation to NCST. So we'll have this up on the website for those that want to refer back to it or share it with others. And we appreciate you doing that, Michael.
Yeah, absolutely. And then in that will be my contact information. So if anybody has questions after the fact, feel free to reach out to me. But thanks for having me, Raquel.
Thank you again for being here. Second year. Thanks, Michael. I have the pleasure now of bringing back Elizabeth Coates, our director of the Homeownership Alliance, and Elizabeth's going to provide us with some updates on legislative and regulatory policy. Thanks, Elizabeth.
Yes, absolutely. Thank you so much. And Michael, thank you again for joining us. A lot of the items that you raised, I'm seeing a connection in what I've prepared to discuss as far as our policy updates. So firstly, in the realm of exciting developments, both the lead tax writers in the House and Senate side have released a bipartisan tax framework. Our national partners at NCSHA have provided an overview, and then this is actually a link just to that framework. For any of you all that are interested in LIHTC, you can certainly rejoice because there are some provisions in there that will likely benefit the work that you do as far as rental housing. Unfortunately, at least within this framework, we are not seeing the Neighborhood Homes Investment Act included. So as we're sort of talking about the low level of affordable supply in the multifamily space, the LIHTC changes will certainly address that, but the single family and affordable homeownership component is not addressed in this tax framework as it is proposed. However, we are in consistent and constant discussions with the lead co-sponsors of this legislation. And something that they let us know is they need to hear from folks on the ground that the Neighborhood Homes Investment Act will be a worthwhile investment and is a worthwhile legislative effort that the tax writers and the entire Congress need to take up. So I will put in the chat our work that NCST helps to lead, the Neighborhood Homes Coalition. If you look at supporters, you'll see a familiar logo as the Mortgage Bankers Association has endorsed the legislation and is a part of our coalition. We are so appreciative to Michael and his team for helping us to really push this forward. So if this is something that is of interest to you, and I hope it will be, bringing on 500,000 affordable new homes on the market within the next 10 years, please engage your elected officials, engage your members of Congress, and engage your senators that this tax deal must include neighborhood homes to be able to fully support the wide breadth of affordable supply that is required to get our way out of this housing crisis. I'll also drop a link in the chat too on our Neighborhood Homes Coalition website. NCST has created an interactive mapping component where you can take a look and zoom in down to the census tract to be able to see how neighborhood homes will support your community. If you are interested in providing static maps, especially as you do your congressional outreach, please reach out to us. This is something very easy for us to replicate. It is such a crucial advocacy tool for a member of Congress to be able to look at their district, look at their state and say, wow, I can see where all of the blue shading, if you're in the maps right now, you can definitely see which census tracts are eligible. And there's lots of incredible momentum that can be built through engaging with this advocacy tool. So we encourage you to raise this. And no, there's no time like the present. At least everything that we are hearing, the Ways and Means Committee on the House side is looking to mark this up on Friday. There's lots of different things that can happen just because you have Senator Wyden on the Democratic side and Chairman Jason Smith on the Republican side in the House in agreement on this framework. You still need quite a few other votes to be able to move it past the finish line. And this is the time for other members to be able to raise what their priorities are. We've got bicameral and bipartisan support for this legislation. Our coalition has been doing a great job in leading the strategy. And we know that you all, many of you all, have done a great job in really letting your elected officials know where it is and how it is that this legislation can be able to lead us out of this affordable housing crisis. So please, if you have any questions on how to message, if you have any questions on the legislation itself, please let us know, because you all are really going to be the ones to implement this. And as such, we hope that you can assist us in this advocacy effort. Moving on to regulatory items, both Michael and Raquel did mention some of the, oh, I just realized I put all of the links in the, just for the host, so I'll share it with everybody. So, all right, that's the bipartisan framework right there. Here's Neighborhood Homes Coalition. And here are the interactive maps. Didn't want to close out without making sure everyone has access to those resources. All right, and back to regulatory. So Michael and Raquel had both raised some great work that FHA had been doing regarding the 203K. NCST and the Homeownership Alliance, we worked on a joint response to FHA's draft mortgagee letter, really explaining the need to be able to improve this program. There are certainly statutory fixes that are required as well. And thankfully, we've been in some good discussions with the Senate Banking Committee on how to be able to improve this. So if your organization is one of the many that perhaps has used this in the past and perhaps has run into some regulatory pitfalls in further utilizing this resource to enhance your rehab work, please feel free to take a look. As well as let me know if this is a space that you want to interact with. Members of the Homeownership Alliance are going to continue to be engaged in active discussions, both on regulatory and legislative changes to this program. Again, on the regulatory front, as the Biden administration is entering its final year of the first term, we're seeing lots of regulatory action. Community development block grants, one of the most popular community development tools that I know many of you on the call are able to take advantage of. This is a very crucial program, one that NCST and the Homeownership Alliance certainly support. However, we've got lots of critiques on how this program can be better maximized to support affordable homeownership efforts. The Homeownership Alliance has created a discussion draft on our proposed policy options for the CDBG program to be able to make it friendlier for owner occupants and for the developers that are using this resource for that purpose. The CDBG proposed rulemaking, HUD has provided a deadline of, I believe, March 10th or 11th to be able to submit public comment. The Homeownership Alliance is going to work very hard in taking this policy options memo that I've shared with you all, revamping it and providing all of the necessary updates to reflect the markets that we are seeing and the affordability challenges that we continue to see. If this is an issue that you feel is important to engage on based on your market, based on the communities that you serve, I really encourage you to take a look at our work in the Homeownership Alliance. This will be a significant priority for us to be able to push, not only to have HUD use their regulatory authority to be able to improve this program, to be friendlier toward homeownership, but also what law changes, what legislative initiatives can be built based on the policy options that we plan to present. And as I mentioned, the Homeownership Alliance, that is our practitioner-led group, our advocacy coalition made up of nonprofits across the country. We continue to actively recruit new members. The stronger and the more diverse coalition that we have will ensure that all of NCST and the Homeownership Alliance's policy recommendations are rooted in your perspective. The worst thing, and as a former staffer, I can say this for sure, the worst thing that I have experienced is putting a bunch of work into perhaps a new bill or legislative proposal, only to find out that it can't be used on the ground. So this work is personal to me, and that I want to be able to serve as this conduit between the nonprofits, you all that are doing incredible homeownership work, and then ensuring that Congress, the administration, understand what levers they can pull to be able to increase the amount of affordable supply, narrow this racial homeownership gap, and really have the housing supply crisis be something of the past. So if any of this is of any interest to you, if you have any further questions on any of our initiatives, I encourage you to take a look at our website. If you want to talk more about what it takes to be a member, it is very easy, and we would love to have you. Please reach out to me via email, and we have a few minutes left, which is not always the case on these calls. So if folks have questions, I'm happy to answer those as well. And if not, my email is in the chat, as well as all the other resources.
Elizabeth, thanks so much. We do have, I think Kevin has raised his hand again, so I do want to just open that up for him. Kevin, hang tight. All right, let us know if you can hear us. You can come off mute.
Yeah, that actually wasn't a question. Since it said we was getting in 2 minutes, I just wanted to say thank you very much. That was very informative, because I had no idea what was going on with the economy and which direction. So it was more just another kudos to everyone.
Thanks so much, Kevin. We appreciate that. And there is a question in the Q&A from Chrissy Barfield. Our NPO is new to this space with a total of 4 multifamilies, yet we want to become a member. So Chrissy, okay, this is just information for you, I think, Elizabeth. Thank you.
Perfect. Thank you so much, Chrissy. Yeah, I'll be in touch. Let's chat about what a membership could look like for you. Thank you.
Thank you. All right, well, I think that those were all the questions that I saw come in. So thank you again to Elizabeth. Thanks to Michael for your presentations and your updates today. I just want to wish everybody a great start to your 2024. And don't forget to join us again next month on February the 21st for our next community impact briefing. And thanks so much for being here. We'll have some information up on our website about this briefing for your resources. Thanks again, everyone. Have a great rest of your afternoon. Bye-bye.